Usually when we talk about a medical diagnosis, there's this expectation of like absolute clinical precision.
Right, like engineering.
Exactly. Like you fall off your bike, you break your arm, they put you in the x-ray machine, and the film shows that unmistakable, jagged white line.
Yeah, and the doctor just points at it and says, there it is, that's the problem.
Right. It's broken or it's not broken, it's clean.
It's comforting, too. I mean, human beings love things that can be visualized, measured, and neatly categorized into a spreadsheet. We want a clear-cut binary reality.
We really do.
Yeah.
But then you step out of the hospital and into the world of macroeconomics and the stock market, and suddenly you realize that the x-ray machine is completely, hopelessly broken.
Yeah, you are looking at a diagnostic landscape that is entirely contradictory.
It makes no sense.
Yeah.
And that's exactly what we are getting into today. Welcome to the deep dive. We are decoding a massive stack of sources today, and I mean massive.
We've got a really broad spectrum of material here.
We really do. We've got deep dive analyses from J.P. Morgan and Morgan Stanley. We have wealth management blogs, economic think tanks, and major financial journalism from outlets like The Guardian and Money.
It's a lot of data to sift through.
It is.
Yeah.
And we're using all of this material to answer one terrifying honestly fascinating question. Why is the stock market booming and hitting record highs while the real everyday economy feels like it's walking on a frayed tightrope over a canyon?
And most importantly, what does this incredible disconnect mean for your money?
Exactly, because you're the one dealing with the consequences.
It is the absolute definition of diagnostic muddy waters. I mean, what we are looking at is a paradox that affects every single person listening to this right now.
Yeah.
It doesn't matter if you are actively day trading every morning or if you just, passively contribute $50 a paycheck to a retirement account and never look at it. You are caught in this crossfire.
You really are. Now, before we really get into the weeds, I want to lay down a very clear ground rule for our deep dive today.
Always a good idea with topics like this.
Yeah, because the stack of sources we're unpacking contains a wildly diverse spectrum of political and economic viewpoints.
Very diverse.
Right. On one side, we have these stark socioeconomic critiques of wealth inequality, critiques of the Trump administration's tariff policies. And on the other side, we have purely capitalist, ruthlessly numbers-driven market analyses from Wall Street banks.
Which can feel like whiplash to read back to back.
Oh, totally. So our strict rule here is impartial exploration. We take absolutely no sides. We do not endorse any political figures. We do not champion any specific policies. Our job is simply to report the ideas contained in the original source material to give you, the listener, a complete, objective 360-degree view of what the smartest minds in finance are seeing.
Which really is the only way to truly understand a system this complex. I mean, knowledge is most valuable when it's understood and applied objectively.
Right. You can't be blinded by ideology.
Exactly. If you let political bias cloud your view of the market, you are going to misinterpret the data. Multiple perspectives are what enrich that understanding. We aren't here to argue about how the world should work.
Right.
We are looking at the raw mechanics, the gears turning beneath the surface of the headlines to see how the world actually works.
Okay, let's unpack this. You log into your brokerage account on a Tuesday morning, and you see the S&P 500 hitting all-time record highs.
Yep.
The NASDAQ is soaring. The financial news networks have the big, bold bull market graphics flashing on the screen. But then in the very same hour, you have experts like Jamie Dimon,
the CEO of J.P. Morgan Chase,
literally the largest bank in America.
Mm-hmm.
You have him going on record to warn that there's a 30% chance of a serious catastrophic market crash.
Yeah, it's jarring.
It's wild. And if you peel back the layers and look closely at specific sectors, like consumer stocks, they aren't just wobbling. They are actively plunging into a bear market.
It feels like massive cognitive dissonance.
It really does.
Mm.
How can the market be at a record high while the people running the financial system are sounding the alarm?
Well, it feels like cognitive dissonance because we have been conditioned to conflate two entirely different things.
Okay.
To truly grasp what the sources are telling us, we have to start by realizing that the stock market and the real economy are essentially two different planets orbiting the exact same sun.
Two different planets.
Yeah. They experience the same gravity, the same broad global events like pandemics or wars, but their atmospheres, their climates, and the biological life that thrives on them are completely fundamentally different.
But people use those terms interchangeably all the time.
Constantly. It's the most common mistake in financial media. People think, oh, the stock market is up today, therefore the economy must be doing great.
Right. Or the economy is struggling, inflation is hurting my grocery bills, so the stock market must be getting crushed.
Exactly. And that is a fundamental misunderstanding of what these two separate entities actually measure. The stock market does not measure the health of the American worker.
I want to look at a staggering statistic from the JP Morgan source that perfectly illustrates this two planets idea, because I think numbers sometimes speak louder than theory.
Oh, the numbers on this are wild.
According to their data, since the year 2000, S&P 500 earnings per share are up an astonishing 356%.
That's huge.
And the total return to the S&P 500 index, if you had just bought and held, is up 632%.
I mean, those are astronomical wealth-generating numbers.
Right. But over that exact same two-decade time frame, nominal GDP, which is the actual measured size of the entire U.S. economy, like everything we produce and consume, has only grown around 200%.
Which is a massive gap.
Yeah. Now, 200% growth isn't terrible, but it is less than a third of the stock market's growth. And it gets crazier.
Yeah, the value line data.
Exactly.
Yeah.
JP Morgan also looked at the average company. They use something called the Value Line Geometric Index, which tracks the median stock rather than just the biggest giants. That index of the average company is only up a measly 47% since the year 2000.
What's fascinating here is how clearly that data proves the divergence. I mean, when the news anchors talk about the stock market, they're almost always talking about the S&P 500.
Right.
But the S&P 500 is not the average American business.
Let me make sure I'm understanding this correctly. The S&P 500 is capitalization weighted, right?
Yeah.
Meaning the bigger the company, the more it dictates the direction of the entire index.
Exactly.
So comparing the S&P 500 to the real economy, it's kind of like,
Yeah.
well, it's like looking at the top 5 gold medal Olympic athletes in the world.
Oh, I like that.
You measure their body fat percentage and their 100-meter sprint times, and then you use that specialized data to confidently declare that the average human being is in the best physical shape in history.
That is a phenomenal analogy. It is exactly like that. The S&P 500 represents the absolute elite, highly optimized, incredibly well-resourced titans of global industry.
Right.
It does not represent the local bakery down the street. It doesn't represent the mid-sized regional manufacturing firm in Ohio that employs 400 people. It doesn't even represent the thousands of smaller publicly traded companies.
So the Olympic athletes are breaking world records, while the rest of us are struggling to jog a mile without pulling a hamstring.
Pretty much.
But why? I mean, what are the actual mechanical gears that make those two planets so different?
Well, if we connect this to the bigger picture laid out in our sources, there are 3 key structural differences that explain why the stock market and the real economy have decoupled so violently over the last 20 years.
Okay, let's go through them.
We have to look at the architectural DNA of both systems. The first structural difference is services versus goods.
Okay, let's walk through what a service economy actually looks like versus a goods economy.
So the U.S. economy, the actual day-to-day reality, the GDP that you and I participate in, is driven overwhelmingly by services.
Right.
Roughly 2/3 of all household spending goes toward human-centric services. We are talking about rent, healthcare, dining out at restaurants, getting a haircut, booking a flight, paying a plumber.
Things people do for each other.
Yes, that is the engine of the gross domestic product. It relies on humans doing things for other humans in real time.
And services are inherently hard to scale. I mean, a hairdresser can only cut one person's hair at a time. A waiter can only serve so many tables in an hour.
Precisely. But the S&P 500, its architectural DNA is entirely different. It is heavily, heavily weighted toward tech, physical products, and scalable digital platforms.
Oh, right.
Technology companies alone make up about 1/3 of the entire index. When you add in industrial equipment, energy extraction, and raw materials, you realize the stock market is essentially a marketplace of tangible goods and infinitely scalable digital infrastructure.
So Microsoft writes a piece of software once, and they can sell 1 million licenses in an afternoon with almost zero additional labor cost.
Yes. The S&P 500 is a marketplace of scale. The real economy is a marketplace of human time.
Wow, that's a great distinction.
So imagine a scenario where the services sector struggles. Maybe inflation hits and people stop eating out at restaurants as much. They cancel their summer vacations. They stretch out the time between haircuts.
Yeah, the real economy takes a massive immediate hit because those service workers lose income.
Exactly. But the S&P 500, it might barely blink. Its core drivers, enterprise software subscriptions, cloud computing, industrial energy contracts, are completely insulated from whether or not you bought a latte this morning.
That is wild. Which brings us to the second structural difference, which I found totally mind-blowing in the JP Morgan analysis: domestic versus international exposure.
Yeah, this is a major blind spot for a lot of investors. The U.S. economy is mostly a closed loop. Despite all the talk about globalization, exports only make up about 11% of the American gross domestic product.
So we mostly just buy from ourselves.
Exactly. The vast, overwhelming majority of economic growth generated in the United States comes from Americans buying things from other Americans.
We are our own biggest customer. But S&P 500 companies are not just American companies anymore. They are multinational behemoths.
Far from it. S&P 500 companies generate roughly 30% of their total sales from overseas markets.
Wow.
And if you look specifically at the technology sector, which, as we established, dominates the index, it's even more extreme. Around 55% of big tech's revenue comes from entirely outside the United States.
So this implies that the S&P 500 is actively insulated from domestic trouble. Like if the U.S. consumer is completely tapped out, drowning in credit card debt, and can't afford to buy a new laptop, it might not matter to Apple or Microsoft if the European or Asian middle classes are still buying smartphones and cloud computing services.
That's exact, right.
They can still post record-breaking global profits even if Main Street America is in a recession.
Not only that, but the JP Morgan analysis points out a counterintuitive mechanism regarding currency that twists this even further.
Oh yeah, I wanted to ask about this.
We usually think of a weak U.S. dollar as a bad thing, right? It means our purchasing power abroad is diminished. But a weak U.S. dollar actually helps these multinational S&P 500 corporations.
Wait, how does a weak dollar help an American company? Walk me through the mechanics of that.
It comes down to currency translation. Let's say an American tech company sells a massive enterprise software license in Europe. They sell it for 1 million euros.
Okay.
If the exchange rate is 1-to-1, that translates to 1 million US dollars on their quarterly earnings report.
Right.
But let's say the US economy weakens and the dollar drops in value against the euro. Now it takes $1.10 to buy a single euro.
Yeah, solving.
That company still sells the software for 1 million euros. They haven't sold a single extra product. They haven't innovated. They haven't gained new market share. Yeah. But when they take those million euros and translate them back into weakened US dollars for their earnings report, it magically becomes $1.1 million. Their revenue just jumped 10% on paper simply because the American economy weakened.
That is wild. So a weak dollar acts as a tailwind for the stock market's earnings. Even though it signals underlying weakness for the average American consumer, the stock market literally profits from domestic currency weakness. Okay, so we have services versus goods and domestic versus international. What is the third structural difference?
Wages versus profits. And this is perhaps the most visceral, emotionally frustrating disconnect for the average person.
Definitely.
The real economy runs on paychecks. When wages go up, when workers have more negotiating power, and when unemployment is low, everyday people have money in their pockets to spend. That velocity of money is what makes the economy thrive.
Right.
But the stock market doesn't run on paychecks. It runs on profit margins. And structurally, wages and profit margins are in direct mathematical conflict.
Because to a corporation, my labor is just a cost. It's a line item on an Excel spreadsheet that needs to be minimized.
Exactly. An employee's paycheck is an expense. It eats into the profit margin. The sources note a staggering data point here. Profit margins for goods industries are currently 60% higher today than they were in the pre-pandemic years of 2018 and 2019.
Think about that. 60% higher. How did they achieve that massive leap in profitability?
Well, let's trace it. It wasn't just magic.
No. They achieved it by aggressively containing labor costs during inflation, using their pricing power to raise the cost of goods for the consumer faster than their own costs went up, and utilizing technology to scale their operations without hiring more human beings.
Yes. So you end up in this bizarre, contradictory scenario. Wage growth for the average worker slows down or gets eaten entirely by inflation, causing massive financial anxiety at the kitchen table. But simultaneously, corporate profit margins soar to historic highs. The stock market throws a massive party to celebrate the exact same corporate efficiency that is actively causing anxiety for the everyday worker.
Which leads us perfectly into one of the most confusing backward things for a lot of people to grasp: the bad news is good news phenomenon.
Oh, this always trips people up.
I can't tell you how many times I've stared at financial news networks and felt like I was losing my mind.
Yeah.
A report comes out saying job growth is totally stalled or unemployment claims have spiked, and instantly, within seconds, the stock market shoots up 500 points.
Yep.
The anchors are cheering. Why on earth does Wall Street throw a parade when Main Street gets a black eye?
It feels incredibly cynical, doesn't it? It feels like the market is actively rooting against the American worker.
It really does.
But there is a cold, mechanical logic to it, and it revolves entirely around one institution, the Federal Reserve.
The Fed, the central bank. Let's break down their role in this.
So the Federal Reserve has what is called a dual mandate from Congress. Their job is to keep inflation in check, stable prices, and to maximize employment.
Right.
They try to balance this seesaw using their primary tool, which is adjusting the federal funds interest rate. When the economy is running too hot and inflation spikes, the Fed raises interest rates to cool things down.
High interest rates act like gravity on the economy.
Exactly. They make borrowing expensive for companies, which slows down corporate expansion, and it usually hurts stock prices.
Because if a company wants to build a new factory, the loan costs twice as much.
Right.
If a consumer wants to buy a house, the mortgage rate is 7% instead of 3%. Everything slows down.
Right. It puts the brakes on. Now, imagine we are in a high interest rate environment and suddenly terrible economic data comes out.
Okay.
Let's use an example from the Morgan Stanley source. They highlighted massive downward revisions in non-farm payrolls. That's a wonky term, but it basically means the government went back and realized, whoops, we actually created far fewer jobs last month than we originally thought.
Meaning job growth is stalling out.
Yeah.
Which is terrible news for the real economy. That means people aren't finding work.
But the stock market doesn't look at that and mourn the unemployed. The stock market looks at that bad data and tries to anticipate how the Federal Reserve will react. The market assumes the Fed will look at the stalling economy, panic about a potential recession, and say, we need to stimulate growth immediately. We need to cut interest rates.
And lower interest rates mean the era of cheap, easy money is back.
Precisely. Cheaper borrowing costs instantly boost future corporate profit margins. Furthermore, when interest rates drop, the yield on safe investments like government bonds drops too.
So suddenly bonds look boring.
Exactly, and investors pull their money out of savings and throw it back into the stock market seeking higher returns. So the market isn't celebrating the job losses. It is celebrating the anticipated cure for the job losses.
It is celebrating the cheap money that will flow from the Fed.
Yes. It is a twisted, almost sociopathic logic, but it is exactly how the algorithmic machine operates.
But we can't just talk about this as an abstract mathematical game played by algorithms in New York. There is a profound, real-world social cost to this disconnect.
Absolutely.
The source from In These Times, which leans heavily into socioeconomic analysis, brought up a really stark critique that stopped me in my tracks. They looked back at the spring of 2020. The pandemic lockdowns.
Oh, yeah. That was a defining moment.
We all remember the terror of that moment. 30 million Americans filed for unemployment in a matter of weeks. Destitute small businesses, family restaurants, local shops were closing forever. The real economy was in a literal freefall. And yet the stock market had its best single month in 30 years.
That specific window in 2020 was the ultimate high-definition stress test of the two planets theory. The divergence between human suffering and financial asset appreciation was absolutely breathtaking.
The article makes this incredibly potent argument. They describe the stock market not as an engine of the economy, but as a wall, a massive fortress insulating the wealthiest 1%, who, let's remind everyone, own roughly half of all individual stocks in America, from the real-world austerity and joblessness experienced by the vast majority.
Yeah, the insulation is structural.
Their argument is that if your wealth is tied up in equities and the Federal Reserve instantly injects trillions of dollars of liquidity to prop up the financial system, you are entirely protected. You might even double your net worth during a global catastrophe, while the guy running the hardware store down the street loses his livelihood.
This raises an incredibly important question about the structural design of our economic interventions during a crisis. Whenever a systemic shock hits, whether it's 2008 or 2020, central banks and governments historically prioritize liquidity in the financial markets.
They bail out the banks.
Right. The prevailing economic theory is that you must save the banking system and the corporate credit markets first, otherwise the entire structure of society collapses. You have to keep the financial plumbing working.
Right.
But the valid critique from in these times is that by doing this so aggressively, you effectively put the investor class on a luxury life raft, while the working class is left treading water in a shrinking real economy.
And the Westpath source, which comes from a wealth management perspective, introduces a term that connects this high-level financial insulation back to the everyday economy. They call it the wealth effect.
The wealth effect is a fascinating blend of human psychology and hard economics. It is the concept that when the value of a household's assets goes up, primarily their stock portfolios and their home equity, people feel significantly wealthier and therefore they change their behavior.
They feel richer, so they act richer.
Exactly. They spend more money, even if their actual biweekly paycheck hasn't increased by a single cent.
So if I log into my 401k and see that my index funds are up 20% for the year, my brain chemistry changes. I might feel comfortable financing a new car, or putting a luxury vacation on my credit card, or remodeling my kitchen. Even though I haven't actually sold those stocks or realized those gains, I'm spending based on paper wealth.
And the Westpath data highlights that the correlation between rising stock prices and this kind of consumer spending is actually getting stronger over time.
Wow.
So look at the feedback loop this creates. The Federal Reserve steps in to prop up the stock market to avoid a financial crisis. This artificially inflates asset prices. The wealthiest 10% or 20% of Americans who own the vast majority of those assets look at their portfolios, feel incredibly rich, and start spending heavily on luxury goods, high-end services, and real estate.
And because consumer spending is 70% of GDP, that top-tier spending artificially props up the broader economic data.
Exactly. It creates this veneer, this shimmering illusion of a booming macroeconomic environment, but it completely masks the underlying rot.
It masks the weakness in the labor market.
Yes. The stagnant wages and the severe struggles of the bottom 50% of Americans who don't own enough stocks to experience the wealth effect. It is, quite literally, a house of cards built on paper, wealth, and psychological confidence.
Okay, so if the stock market is this fundamentally detached from the real boots-on-the-ground economy, what is it actually connected to? If it's not a rational reflection of Main Street reality, what forces are driving these multi-trillion-dollar valuations?
That's the billion-dollar question.
From our massive stack of sources, the answer seems to boil down to three things: irrational expectations, blind automated money, and the immense gravitational pull of just a handful of companies. Which brings us to the concept of the multi-headed bubble and the massive myth of the efficient market.
To understand the bubble, we first have to understand the theory that Wall Street uses to deny that bubbles exist.
Right.
It's called the efficient market hypothesis, or EMH. It is a foundational theory taught in every Finance 101 class. EMH argues that stock prices perfectly and instantly reflect all currently available public information.
It assumes that the market is a perfectly rational machine.
Yes. It assumes that millions of investors process data flawlessly, and therefore, at any given second, every single stock is trading at its exact, fair intrinsic value. According to strict EMH, there is no such thing as an overvalued or undervalued stock. The price is always right.
I have to push back on that immediately, and the sources do too. Because if the market is this ultimate, perfectly rational voting machine that prices reality with robotic precision, how on earth do we explain the last 5 years?
You're thinking of the meme stocks.
Yes. How do we explain meme stocks? We all saw companies that were literally going bankrupt. Car rental companies, movie theater chains, video game retailers with shrinking revenues suddenly surge in value to billions of dollars, purely because anonymous people on internet forums thought it would be funny to squeeze the hedge funds.
Yeah, it was wild to watch.
How is a bankrupt company gaining 500% in a week a perfectly rational pricing mechanism?
You've hit the exact fatal critique raised by the Independent Institute source. They argue that the efficient market hypothesis relies on neoclassical economic assumptions of perfect human rationality.
Which doesn't exist.
Right. And sure, that looks beautiful when you write the equations on a chalkboard in an Ivy League classroom. But it falls apart catastrophically when you apply it to actual emotional, panicky human beings. This is where the field of behavioral economics steps in to explain what EMH misses.
Let's really dig into behavioral economics. How do our brains betray us when we invest?
Well, because humans are not perfectly rational calculating machines, we are apes with anxiety.
Huh, that's true.
We suffer from deep cognitive biases. One of the most powerful forces in behavioral finance is loss aversion. Psychological studies have proven that the emotional pain you feel from losing $100 is roughly twice as intense as the joy you feel from finding $100. We are wired to avoid loss at all costs.
How does that translate to the stock market?
It causes investors to act wildly irrationally. If an investor buys a stock and it immediately drops 20% because the company has terrible earnings, a rational machine would reevaluate the intrinsic value and sell.
Take the loss and move on.
Exactly, but the human brain refuses to accept the pain of realizing that loss, so they hold on to the losing stock for years, telling themselves, I'll just wait until it gets back to what I paid for it, even as the company marches toward bankruptcy.
Right.
Conversely, if a stock goes up 10%, they sell it immediately to lock in a tiny win, terrified of losing the profit, completely missing out on years of compound growth. Fear and greed dictate prices, not just rational math.
And the Independent Institute analysis brings up an analogy that I absolutely love for explaining why the market gets so disconnected from reality. It's a Keynesian beauty contest. Can you walk us through that concept?
Oh, it's a brilliant thought experiment from the legendary economist John Maynard Keynes, and it perfectly captures modern market speculation. Imagine a newspaper runs a contest. They print photographs of 100 different faces, and they ask the readers to pick the 6 prettiest faces.
Okay, simple enough.
But here's the catch. The prize money doesn't go to the person who picks the faces that are objectively the prettiest. The prize goes to the person whose 6 choices most closely match the average preferences of all the other competitors who mailed in their votes.
Oh, wow. Okay, so if I want to win this money, I am no longer looking at the newspaper and asking myself, who do I personally think is the most attractive? That's irrelevant.
Exactly.
I have to look at the photos and ask, who do I think the average person thinks is the most attractive?
Yes. You have to guess the crowd's psychology. And if you take it a step further, the really sophisticated players aren't even asking that. They're asking, who do I think the average person thinks that everyone else thinks is the prettiest?
That's insane.
It becomes this dizzying metagame of anticipating mass psychology rather than evaluating intrinsic value.
And how does that map onto the stock market?
Applied to Wall Street, it means an investor might buy shares in a completely unproven AI startup or a meme stock, not because the company makes a great product, not because they have solid cash flow, and not because the math makes sense. They buy it simply because they expect that other people will want to buy it tomorrow at an even higher price.
Right.
The intrinsic value of the business is irrelevant. All that matters is the momentum of the crowd.
That perfectly explains the massive crypto booms, the NFT craze, and the meme stocks.
Yeah.
People buying digital assets purely because the line is going up, assuming they can find a greater fool to sell it to before the music stops.
Exactly.
And the Independent Institute source uses a very specific real-world example to shatter the efficient market hypothesis once and for all. They point to the hedge fund renaissance technologies, specifically their medallion fund.
Oh, their numbers are legendary.
They achieved an annualized return of 66% between 1998 and 2021. 66% every single year for over 2 decades. If all information is perfectly priced into the market at all times, as EMH claims, an outperformance of that magnitude should be a mathematical impossibility.
It is the ultimate proof that the market is not perfectly efficient. It proves that there are deeply embedded inefficiencies, irrationalities, and behavioral patterns that highly sophisticated algorithms can exploit.
Right.
But beyond human psychology and hedge funds, there is a massive, blind, structural force that is actively driving stock prices away from their true intrinsic value today. And this might be the biggest shift in modern financial history, passive investing.
Right. The invention and absolute domination of the index fund.
Yes. For decades, investing meant paying an active manager to pick good stocks and avoid bad ones. But John Bogle and Vanguard changed that by creating the index fund, a basket of stocks that just blindly tracks the whole market.
Which was revolutionary.
It was a brilliant, low-cost innovation. But today, the scale of it has warped the system. Over 50% of all invested money in the U.S. stock market is now passive. It is entirely automated.
I am guilty of this. Every single month, a chunk of my paycheck gets automatically deducted and buys a target date S&P 500 index fund. I don't look at the individual companies. I don't read their quarterly reports. The money just vanishes into the machine.
Millions of people do exactly what you do. It's the standard retirement advice. But we have to look at the mechanical consequence of that. When your money goes into an S&P 500 index fund, the algorithm doesn't analyze the market. It blindly distributes your cash to the 500 companies in that index based purely on their market capitalization, their size.
Okay.
The bigger the company, the more of your money it automatically receives.
Wait, let me stop you there. Does that mean the index fund buys the stock regardless of whether the company's actually a good deal at that moment?
Completely regardless. The algorithm doesn't care if the company is massively overvalued or incredibly undervalued. It doesn't look at price to earnings ratios. It doesn't look at debt levels. It doesn't care if the CEO just resigned in a scandal. If the company is in the index, the algorithm buys it, period.
So passive investing essentially acts like a giant blind fire hose of cash.
Yeah.
It's just indiscriminately spraying money at the largest companies every single time a paycheck clears in America.
Blind fire hose is the perfect term. And this structurally props up the valuations of massive companies far beyond what their actual business merits. The Independent Institute points to Home Depot as a prime example.
What's going on with Home Depot?
They noted that Home Depot was trading at an aggressive price-to-earnings, or PE, ratio of 25. Now, Home Depot is a fantastic, highly successful, profitable company, but it is a mature, big-box hardware store. Historically, a PE ratio of 25 is a premium valuation reserved for hypergrowth technology startups that are doubling their revenue every year.
Not a company selling lumber and drill bits where the growth is tied to the housing market.
Exactly. But because Home Depot is a massive mega cap component of virtually every passive index fund and retirement account, the constant blind inflow of passive capital forces its stock price higher and higher, completely untethered from its fundamental growth prospects.
Okay, if passive investing is just a blind fire hose, automatically buying the biggest companies because they are the biggest companies, which makes them bigger, which makes the index fund buy more of them, isn't that essentially the mechanical definition of giant Ponzi scheme? The early money only grows because automatic 401k deductions force new money in.
That is a very controversial but increasingly common critique among active managers. It's a self-fulfilling momentum loop, and it leads us directly to the specific vulnerabilities our sources identified. When you combine human irrationality, the Keynesian beauty contest, and the blind fire hose of passive investing, you create an environment perfectly engineered for historical bubbles. Let's look at the anatomy of our current market fragility. Both the American Prospect and the Guardian sources map this out. Let's start with the most glaring one, the AI and hyper-concentration bubble.
The market just feels incredibly top-heavy right now.
Top-heavy doesn't even begin to describe it. It is unprecedented. According to the data, just 5 technology companies currently make up roughly 22% of the entire stock market's total value.
22%.
Yeah.
5 companies out of thousands.
Yes. The Morgan Stanley source highlights this starkly by looking at what Wall Street calls the Magnificent Seven, the mega-cap tech giants like Apple, Microsoft, NVIDIA, Google, Amazon, Meta, and Tesla. According to their analysis, the earnings of the Magnificent Seven are growing at an incredible 26% annually.
Wow.
They're cash printing machines. But if you strip them out and look at the other 493 companies in the S&P 500, their collective earnings growth is practically flat, 0%.
So when the news anchors tell us the S&P 500 is hitting record highs, it's a total illusion. It's not 500 American companies succeeding together. It is 7 incredibly powerful tech giants, dragging 493 stagnant hitchhikers up the side of a mountain.
That's a great visual. And the systemic danger is obvious. Right now, investor sentiment is completely euphoric about artificial intelligence.
Huh.
These massive companies are pouring tens of billions of dollars into AI data centers and chips. But what if that sentiment cools?
Yeah.
What if the massive capital expenditures into AI infrastructure don't yield immediate world-changing trillion-dollar profits in the next 2 years? What if the AI rollout is slower than expected?
If those 7 pillars stumble, the entire roof caves in.
And because of that passive investing fire hose we just talked about, there is nowhere to hide. If the tech giants fall, they drag the S&P 500 index down, which means every index fund and retirement account bleeds value simultaneously.
That's terrifying.
The Guardian article specifically warned international investors about this. They noted that even if you live in Europe and you think you are playing it safe by investing in a global equity tracker instead of a U.S. fund, well, the United States accounts for 72% of the MSCI World Index. And that U.S. chunk is utterly dominated by tech. So, if NVIDIA or Microsoft has a bad quarter, your global diversification won't save you.
The contagion is absolute. And the American Prospect also identified another symptom of this exact same speculative disease, the crypto and SPAC bubble. We watched the cryptocurrency ecosystem reach an astonishing valuation of $3 trillion, and then there were SPACs.
SPACs, special purpose acquisition companies. These were the ultimate symbol of market mania.
Explain to the listener what a SPAC actually was, because looking back, it feels like collective insanity.
A SPAC is essentially a blank check shell company. A famous investor or a celebrity says, give me $1 billion. I don't have a business yet. I don't sell anything, but trust me, I will use this $1 billion to go find a cool private company and take it public.
That is just wild.
It allowed shady or unproven businesses to merge with the SPAC and become publicly traded without having to go through the rigorous, exhaustive financial disclosures and SEC audits normally required for a traditional initial public offering.
It was basically asking retail investors to hand over their life savings based on nothing but a rumor and a slick PowerPoint presentation.
Precisely. And we have to ask why. What fueled all of this speculative excess? Why were people throwing money at zero revenue SPACs, meme stocks, and JPEGs of cartoon apes?
Right. Why were they doing it?
It wasn't just mass delusion. It was a rational response to the macroeconomic environment created by the Federal Reserve. It was the zero interest rate environment combined with an insidious psychological phenomenon known as the Powell put.
Oh, I really want to unpack the Powell put, because this ties perfectly back into our earlier conversation about how the market reacts to bad news. What is a put, and how does it drive speculation?
It's a concept that traces its origins back to the late 1990s with then Fed Chair Alan Greenspan. It was originally called the Greenspan put. In options trading, a put is a contract you buy that guarantees you can sell an asset at a specific, predetermined price. It's an insurance policy that protects you from catastrophic losses. If the stock crashes, your put option saves you.
Okay, so it's a safety net.
Yes. The Greenspan put, which evolved into the Bernanke put and is now the Powell put, referring to current Fed Chair Jerome Powell, isn't a literal contract. It is the deeply ingrained psychological belief among Wall Street hedge funds and institutional investors that the Federal Reserve will always, without fail, ride to the rescue if the stock market drops by more than 15 or 20%.
So investors believe the Fed acts as a massive, invisible safety net under the entire market.
Exactly. Let's use an analogy. Imagine you are asked to walk a tightrope between two skyscrapers. Normally, you would walk incredibly slowly, terrified, carefully testing every single step because the penalty for failure is death. That is how investors should act. They should carefully evaluate risk.
Right.
But what if you knew with 100% certainty that there was a massive, bouncy trampoline positioned 10 feet below the tightrope?
If I know there's a trampoline underneath me, I'm not going to walk carefully. I'm going to run across the rope. I might even try to do backflips to show off, because the worst that happens is I bounce back up.
And that is exactly what investors are doing with zero revenue meme stocks, SPACs, and crypto. The belief is that if the market drops, the Fed will panic about a recession and immediately cut interest rates to zero or print trillions of dollars in quantitative easing to prop asset prices back up.
Wow.
If investors fundamentally believe their downside is capped by the central bank, they take on drastically, irrationally more risk. It creates a massive moral hazard. It guarantees the inflation of bubbles.
Here's where it gets really interesting. We've established that the market is completely disconnected from the everyday economy. We've established that it is highly concentrated in just a few tech companies, propped up by the blind fire hose of passive money, and fueled by the speculative backflips of the Powell put. So, if this structure is so incredibly fragile, what are the actual pins threatening to pop this multi-headed bubble right now? What are the catalysts?
The vulnerabilities are significant, and they aren't theoretical anymore. They are manifesting in very specific areas of the economy right now. If we look at the data from our sources, the cracks in the foundation are appearing first, where the real economy meets the corporate balance sheet.
Let's start with the American consumer, because the Money Magazine source highlighted something genuinely alarming. While tech and AI are soaring to the moon, consumer discretionary stocks are in a literal, undeniable bear market.
It's a bloodbath there.
Before we look at the carnage, let's define the terms. What is the difference between a consumer staple and a consumer discretionary stock?
It's the difference between needs and wants. Consumer staples are the companies that sell things you have to buy, regardless of whether the economy is booming or collapsing. Toothpaste, basic groceries, toilet paper, medication. You don't stop buying toilet paper during a recession.
Right, definitely not.
Consumer discretionary stocks are companies that sell things you want to buy but can absolutely live without if your budget gets tight. Vacations, designer clothing, restaurant meals, luxury appliances, amusement park tickets.
And right now, these price-sensitive discretionary sectors are seeing absolute carnage. I'm looking at the numbers pulled directly from the source. Whirlpool, the appliance manufacturer, is down 50% from its highs. Nike, one of the most iconic consumer brands on earth, is down 20%. Six Flags, the massive amusement park company, is down an astonishing 69%.
It's brutal.
What is the mechanism happening here? Why are these specific giants bleeding out while tech soars?
It is the clearest signal we have that the American consumer is finally tapped out. The excess savings that families accumulated during the pandemic stimulus era are gone, completely exhausted, and years of compounding sticky inflation have severely eroded the purchasing power of the average paycheck.
That makes sense.
But there is a specific immediate catalyst that is plunging these specific companies into a bear market: the implementation of new, aggressive trade tariffs by the Trump administration.
The sources mention an effective tariff rate approaching 18%. Now, tariffs generate a massive amount of political noise and partisan arguing, but keeping our impartial rule in mind, let's just talk about the raw mechanics. How does a tariff actually work, and why does it destroy the stock price of a company like Nike?
Let's look at the supply chain objectively. A tariff is simply a tax imposed by the domestic government on imported goods at the border. The political goal is usually to protect domestic manufacturing by making foreign-made goods more expensive.
Okay.
But the mechanics of how it impacts a multinational corporation's balance sheet are brutal and straightforward. Let's use Nike as the example. Nike manufactures the vast majority of its shoes overseas in places like Vietnam or China, and then imports them into the United States to sell in retail stores. If the government slaps an 18% tariff on imported footwear, Nike's cost of goods sold just increased by 18% overnight.
So Nike is suddenly faced with a terrible choice. They have two options. Option A, they can just absorb that 18% tax themselves, but that destroys their profit margins. And as we discussed earlier, Wall Street runs entirely on profit margins. If Nike says, we'll just make less money, Wall Street will punish their stock instantly.
Correct. Which leads to option B.
Option B, Nike refuses to take the hit and instead passes that 18% cost directly onto the consumer by raising the price of the shoes. A $100 pair of sneakers becomes a $118 pair of sneakers.
Exactly. And here's where the macroeconomic reality collides with corporate strategy. We just established that the consumer is already stretched thin, dealing with higher rent, higher grocery bills, and credit card debt.
Yeah.
If you suddenly raise the price of discretionary sneakers by 18%, you hit a wall of elastic demand. People simply stop buying the shoes. They wear their old shoes for another year. Nike's sales volume plummets.
And the stock drops.
Wall Street sees the dropping sales volume, anticipates terrible future earnings, and aggressively sells off the stock. That is why a tariff announcement can cause a consumer discretionary stock to drop 20% in a matter of weeks.
And it doesn't stop at the border.
Right.
Because tariffs operate on Newton's third law for every action, there is an equal and opposite reaction.
You're referring to retaliatory tariffs, which are practically guaranteed in global trade. When a major economy like the U.S. imposes tariffs on imports, trading partners do not just sit there and accept it. They immediately impose retaliatory tariffs on American exports.
So if we tax their steel or their electronics, they turn around and put a massive tax on American soybeans or American whiskey or American airplanes.
Right. It creates a destructive feedback loop. It raises prices for domestic consumers, it destroys profit margins for domestic importers, and it simultaneously cripples domestic exporters whose goods are suddenly too expensive to sell abroad. The stock market is a forward-looking, anticipating mechanism.
So it prices it in early.
It doesn't wait for the earnings report to come out in 6 months. It sees the tariffs implemented today, calculates the mathematical hit to global profit margins, and aggressively dumps consumer stocks. This is a massive, flashing warning sign that the real economy is buckling under pressure.
Okay, so the consumer is waving a white flag, and the trade wars are crushing retail. But there's another danger sign lurking in our sources that might be even more structurally terrifying than tariffs. The Husband Fund's analysis dives deep into the inflation and deficit time bomb.
This part is crucial.
And honestly, reading this part felt like a paradox. Because right now, headline unemployment is incredibly low, around 3.6%. The broader economy has been technically expanding for years. So why on earth should we be panicking about government debt right now? Isn't debt only a problem during a recession?
That is exactly the paradox, and to unravel it, we have to understand the concept of cyclically excessive deficits. This is crucial to grasp. Government deficits, which simply means the government is spending more money than it brings in through tax revenue, typically operate on a very predictable economic cycle.
Let's use a household analogy.
Perfect. Think of the government like a household. During a severe recession, millions of people lose their jobs. When people aren't working, they aren't paying income tax, so the government salary drops dramatically.
Right.
At the same time, the government has to spend billions more on safety net programs like unemployment benefits and food stamps to keep society functioning. So the deficit naturally, understandably, expands. You are unemployed, so you put your groceries and rent on a credit card to survive the storm. That is a normal cyclical deficit. It acts as an economic shock absorber.
That makes total sense, but what happens when the storm passes?
During an economic expansion, the reverse is supposed to happen. When unemployment is down to 3.6%, millions of people are working and paying income taxes. Tax revenues surge. Simultaneously, very few people need unemployment benefits, so safety net spending drops.
So the deficit shrinks.
In a healthy cycle, the deficit should theoretically shrink significantly or even turn into a surplus, allowing the government to pay down the debt.
Like, you got a great job, you got a raise, so you stop using the credit card and you start paying off the balance.
Exactly. But the terrifying reality right now, highlighted by Hessman, is that the U.S. government has completely detached from this cycle. Even after a long economic expansion with incredibly low unemployment and soaring corporate profits, the U.S. federal deficit exploded to roughly $1.1 trillion.
So, to use our analogy, we have a booming economy, we have a great job, a massive salary, low unemployment, and yet we are still putting over $1 trillion of groceries and vacations on the national credit card every single year.
Yes. We are spending as if we are in the deepest, darkest depths of a recession, while simultaneously claiming we are at the peak of an economic boom. And Hessman explains the brutal math of why this is a ticking time bomb. Right now, that massive deficit is roughly 5% of our total GDP. Historically, given where we are in the economic cycle with full employment, the deficit should be around 1%.
Okay, so we are overspending by a massive margin. What happens if the economy actually does slow down?
That is the terrifying part. If the economy were to simply cool off, we aren't even talking about a 2008-style financial collapse, just a totally normal, run-of-the-mill year of flat 0% GDP growth. The automatic stabilizers would violently kick in.
What does that mean?
Tax revenues would plummet, unemployment spending would spike, and because we are already starting from a baseline of a $1.1 trillion deficit, a minor recession could easily push the deficit to $1.5 trillion, $2 trillion, or beyond.
Which is the extreme panic level we only saw during the peak of the 2008 global financial crisis or the 2020 pandemic lockdowns, but we would be hitting those levels during a minor speed bump.
Exactly. We have exhausted our fiscal shock absorbers during peacetime, and the Hessman analysis draws a very chilling historical parallel to the late 1960s and 1970s.
The inflation era.
During that era, with the Vietnam War and the massive expansion of Great Society domestic programs, the U.S. ran cyclically excessive deficits. They spent heavily despite a relatively strong underlying economy, and it led to a profound crisis of confidence. The public, and more importantly, global bond markets, lost faith that the U.S. government had a stable, mathematically sound fiscal trajectory.
And when you lose faith in the currency, you get inflation. Because inflation isn't just about supply chains. It's heavily driven by human psychology and expectations.
Spot on. It destabilized inflation expectations. When everyday people and massive corporations expect inflation to remain high, it becomes a self-fulfilling prophecy. Workers go to their bosses and demand higher wages to afford future price hikes. Businesses raise the prices of their goods today in anticipation of higher costs tomorrow.
And then you're stuck in it.
It creates a wage price spiral that is incredibly difficult to break.
And how does the government actually finance a $1.5 trillion deficit? They don't just have a giant checking account with cash sitting in it.
They have to borrow it. They issue treasury bonds. They ask the public, foreign governments, and institutions to lend them money. But if the deficit is too large, there aren't enough buyers. So what happens? The Federal Reserve steps in and effectively prints new money out of thin air to buy those government bonds. They monetize the debt.
Which dilutes the value of every existing dollar in circulation.
Precisely. When the issuance of government liabilities, debt, and currency becomes excessive relative to the actual productive output of the economy, the free market begins to devalue those liabilities. The risk that the stock market is currently blissfully ignoring is that this mountain of excessive government debt will simultaneously devalue both treasury bonds and the U.S. dollar itself.
That's a nightmare scenario.
That triggers deep structural inflation. And structural inflation cannot be easily cured by the Fed just raising interest rates 0.25%. It requires agonizing economic pain to break.
This is incredibly heavy. We have a tapped-out consumer base buckling under tariffs. We have a multi-headed tech and passive investing bubble entirely dependent on momentum. And we have cyclically excessive deficits threatening structural 1970s-style inflation. Which brings us to the inevitable question, crash mechanics.
That's candy there.
If these theoretical threats actually materialize, what does a crash look like?
Mm-hmm.
Because I think the definition of a crash has been warped in recent years by the Fed always rushing in to save the day. Let's start with a foundational definition from the Money article. What is the actual technical difference between a bear market and a recession?
They're intimately related, but they describe two entirely different spheres of reality. A bear market is strictly a financial market term. It is a mathematical threshold. It occurs when investment prices like the S&P 500 or the NASDAQ drop by 20% or more from their most recent all-time highs.
Oh, okay.
Historically, bear markets happen fairly regularly, and they last an average of about 11 months before the market starts recovering.
Okay, so a bear market is your 401k statement. Looking depressing. What is a recession?
A recession is a macroeconomic term. The traditional textbook definition is 2 consecutive quarters, so a full 6 months of shrinking gross domestic product. It means the entire economy is producing fewer goods, providing fewer services, and generating less wealth than it did the year before.
So to simplify, a bear market is your stock portfolio losing its paper value, but a recession is the economy itself actually shrinking in the real world.
Exactly. And the Money article goes out of its way to emphasize why a recession is profoundly, existentially worse for the average person. A bear market hurts Wall Street. It causes anxiety for hedge fund managers. It destroys paper wealth that might not have been real to begin with.
Right.
But a recession takes your job. It forces the local restaurant down the street to board up its windows. It forces families into foreclosure. And perhaps most importantly, a deep recession fundamentally alters cultural and consumer behavior.
Oh, totally.
People who live through a severe recession, like the generation that lived through the 1930s, or the millennials who entered the workforce in 2008, changed their relationship with money, debt, and risk for decades out of sheer trauma. A bear market is a financial event. A recession is a human event.
But they don't always happen at the same time, right? The market doesn't perfectly track the economy.
Correct. The stock market is a forward-looking, anticipating mechanism. It is always trying to guess what will happen in 6 months. So the market often drops into a bear market, anticipating that a recession is coming. It tries to price in the pain before it arrives.
But it gets it wrong sometimes.
Oh, absolutely. Sometimes the market gets spooked, anticipates a recession, sells off, and then the recession never actually materializes. The economy muddles through. The old joke among cynical economists is that the stock market has successfully predicted 9 out of the last 5 recessions.
That's a great line. But when we look at the potential for a market correction today, and we look at the data and the sources, the numbers are truly, genuinely staggering. The Hussman Fund's analysis makes a claim that stopped me cold.
Yeah, his numbers are intense.
He claims that a 60 to 65% market loss right now wouldn't even be a bizarre anomaly. It wouldn't be a black swan event. He argues a 60% drop would just be a return to standard historical norms.
I know, it's hard to hear.
I had to reread that paragraph 3 times. A 60% drop in the S&P 500 would wipe out trillions of dollars. It would be catastrophic. How could you possibly argue that is normal?
I know it sounds hyperbolic, it sounds like doomsday fear-mongering, but Hussman's argument is not based on emotion. It is rooted in deeply tested mathematical historical valuation metrics. He doesn't just look at the raw price of a stock, he uses something called the margin-adjusted PE, or MAPE.
Okay, we need to slow down and explain MAPE, because this is the crux of the argument. I understand standard PE. Price to earnings. If a stock costs $100 and the company earns $5 a year per share, the PE is 20. It takes 20 years of earnings to pay back the price. What makes MAPE different?
Standard PE can be incredibly deceptive because corporate profit margins fluctuate wildly over time. As we discussed right now, profit margins are at historic artificial highs because companies squeezed labor and raised prices during inflation.
Right.
If you calculate a PE ratio using today's temporarily inflated earnings, the stock might look reasonably priced. But what happens when the economy normalizes? Consumers stop paying $8 for a box of cereal, and those profit margins collapse back to their historical average. Suddenly, that stock is massively overvalued.
So it's like judging a marathon runner's normal everyday pace by only timing them while they're running downhill with a massive 30-mile-per-hour tailwind.
That is exactly what it's like, because eventually the track levels out, the wind stops, and you see their true speed. Margin-adjusted PE strips away that temporary tailwind. It looks at the price of the market relative to revenues, but it adjusts the earnings to assume a normal historical profit margin across the entire economic cycle.
Okay, that makes a lot of sense.
It is designed to strip out the temporary distortions of zero interest rates, government stimulus, and artificial pricing power. It provides a true apples-to-apples comparison of stock valuations across 100 years of market history.
And when you apply this normalized apples-to-apples metric to today's market, what does the X-ray show?
It shows a historically unprecedented bubble. When you look at MAPE, the current stock market valuations exceed both the 1929 peak right before the Great Depression and the 2000 peak right before the dot-com crash.
Sweet. We are more overvalued right now than we were before the two most devastating financial crashes in modern human history.
According to this specific, historically cycle-adjusted metric, yes, we are in uncharted territory, and Hussman draws a vital, terrifying contrast with the year 2000.
The dot-com bubble.
During the dot-com bubble, the extreme overvaluation was largely isolated to a single specific sector, large-cap technology and internet stocks. The top 10% of stocks in the market were absurdly, comically overvalued. Companies with zero revenue adding .com to their name and going public for billions.
Yeah, pets.com.
Exactly. And when that bubble finally burst, that specific top decile of stocks lost 83% of their value. It was a bloodbath for tech. But the rest of the market, the boring manufacturing companies, the utilities, the value stocks, wasn't nearly as stretched. Many of them actually went up during the crash as money fled tech for safety.
But today is different. The bubble isn't isolated.
Today is the broadest equity bubble in recorded financial history. Hussman's data shows that every single decile of stocks, from the massive Magnificent Seven tech giants all the way down to the smaller, boring, everyday companies, is severely overvalued compared to their historical norms.
Because of the index funds.
This is what the blind fire hose of passive index investing has done. It has inflated everything simultaneously. Every single decile of the market would require a massive drop between 59% and 71% just to reach a normal run-of-the-mill historical valuation baseline. Let me repeat that. A 60% drop wouldn't make the market undervalued or cheap. A 60% drop is mathematically required just to get back to average.
That is incredibly sobering. It's almost hard to wrap your mind around a drop of that magnitude.
Yeah.
And to give context to what a historic systemic crash actually feels like mechanically, Hussman details the anatomy of the 1929 crash, because we tend to think of 1929 as just one really bad week in October where people jumped out of windows and then it was over. But that's not how it happened. The market dropped a total of 89.2% between 1929 and 1932, but it happened in distinct, agonizing phases.
Yes, understanding the mechanics of how a 90% wipeout actually happens is crucial because it isn't a single event. Hussman describes 1929 as two distinct compounded losses.
Okay, break it down.
The first loss was a severe but entirely predictable two-thirds drop. That initial 66% plunge was exactly what we were talking about today. It simply brought the absurd, euphoric, debt-fueled, speculative valuations of the Roaring '20s back down to normal, boring, historical levels.
So phase one was just erasing the mania, returning to the baseline.
Exactly. If it had stopped there, it would have been a painful bear market, but society would have recovered relatively quickly. But then came the second phase. Severe policy errors by the government and the Federal Reserve turned a standard financial correction into the Great Depression.
What did they do?
The Fed actually raised interest rates during a banking crisis to defend the gold standard, choking off liquidity. The government implemented massive protectionist tariffs, the Smoot-Hawley Tariff Act, which sparked a global trade war and destroyed exports. These colossal policy errors caused an economic cataclysm. Corporate earnings didn't just normalize, they collapsed entirely. And that fundamental collapse caused the market to lose two-thirds of its remaining value.
Wow. Okay, let's do the terrifying math on that. You start at the $100. Phase one, the valuation correction wipes out two-thirds. You are down to $33. Then the policy error phase wipes out two-thirds of that remaining $33. You lose another $22. You are left with $11. That is how you get from a booming market to a 90% wipeout.
Yes, it is compound destruction. Now, it is very important to clarify, Hussman is not predicting a second Great Depression.
That's good to hear.
He doesn't expect the central banks today to repeat the exact same catastrophic errors of 1930. He doesn't expect the second fundamental collapse. But his core argument is that the first drop, the 60 to 65% initial correction just to erase the current speculative premium and return to normal valuations, is mathematically baked into the current prices. It is a statistical inevitability.
So what does this all mean for the listener? If the math absolutely demands 60% drop just to reach normality, why hasn't it happened yet? Why is the market still hitting record highs today? Yeah, Hussman argues it's because investors are operating on pure, unadulterated speculative psychology. He uses this great equestrian phrase. He says, investors have the bit in their teeth, like a runaway horse that is sprinting blindly, completely ignoring the rider desperately pulling on the reins. Investors are actively ignoring the underlying fundamentals. They don't care about the MAP ratios. They don't care about the stagnant revenues. They don't care about the trillion-dollar deficits because the upward momentum is intoxicating.
They are playing the Keynesian beauty contest to the extreme.
Right. Assuming that no matter what the price is today, some greater fool will buy it for more tomorrow.
It's a psychological disposition that overrides math. Valuation metrics like MAPE are incredibly reliable, but they are long-term tools. They tell you about the 10-year or 12-year expected return of the market. They act like gravity. But in the short term, over a period of months or even a few years, market internals, the psychological momentum, the FOMO, the passive inflows, can keep a bubble expanding far, far longer than any rational model would dictate. The market can remain irrational longer than you can remain solvent.
Which brings us to the most practical, important part of this entire deep dive. We've talked about the macro theory. We've talked about Jamie Dimon warning of a 30% crash risk. We've talked about Hussman's data demanding a 60% valuation reversion. If you are listening to this right now on your commute or while walking the dog and you have a 401k, an IRA, or just a basic brokerage account, it is incredibly easy to feel a sense of rising panic. You might be tempted to pull over and sell everything to hide in cash.
Understandable, but a bad idea.
Exactly, because the sources we reviewed, specifically The Guardian, Money, and Morgan Stanley, provide highly actionable strategic advice for exactly this moment.
Yeah.
Let's distill the survival guides. How do we shield our finances from the fallout without panicking?
The very first and arguably the most critical rule from every single source we analyzed is this: do not panic. Do not let emotion dictate your financial strategy. Time is your absolute greatest ally in investing.
Let's really expand on the mechanics of that, because it's easy to say don't panic, but it's hard to do when the screen is bleeding red. The Guardian points out that pensions, 401ks, ISAs in the UK, these vehicles are mathematically designed for timelines of decades, not months.
Exactly. We need to distinguish between paper losses and realized losses. If the market crashes tomorrow and your portfolio drops 40% in value on your screen, you haven't actually lost any money yet. You still own the exact same number of shares in the exact same companies that you owned yesterday. The only way you turn that temporary paper loss into permanent actual financial destruction is if you panic, log into your account, and click sell at the absolute bottom. If you sell, you crystallize the loss. You lock it in forever.
And as the Money article points out, the danger of panic selling isn't just locking in the loss, it's missing the recovery. The first few years immediately following a bear market bottom usually see outsized, explosive, record-breaking gains. The market slingshots back up as valuations become cheap and attractive. If you sold your shares in a panic and moved to cash, you were sitting on the sidelines watching the train leave the station. You missed the recovery entirely.
That is precisely why having a robust, liquid emergency fund is the foundational bedrock of any financial survival strategy. An emergency fund is your financial shock absorber.
Let's run a hypothetical scenario to prove why that matters. Say we hit a deep recession. The stock market drops 50%. And worse, because it's a real economic recession, you lose your job. If you do not have cash savings, you still have to pay rent, buy groceries, and keep the lights on. So what do? You are forced, against your will, to liquidate your 401k or sell your stocks at the absolute bottom of the market just to survive.
And that's how you destroy your long-term wealth because of a short-term cash flow crisis.
Right.
But if you have 3 to 6 months of basic living expenses sitting safely in a high-yield savings account, completely detached from the stock market, you have built a fortress. You can weather the storm. You can pay your rent, search for a new job, and completely ignore your dropping stock portfolio. You give your investments the time they mathematically need to recover without being forced into a fire sale.
Okay, so step one is behavioral, don't panic.
Yeah.
Build a cash shock absorber. What is step two? The sources heavily emphasize strategic diversification. And this means moving beyond the basic advice of just buy an S&P 500 index fund and forget about it.
Right. Because, as we painstakingly established, the S&P 500 is no longer a diversified representation of the economy. It is incredibly top-heavy, dominated by a few tech giants. If you only own the S&P 500, you are heavily concentrated in one sector of one country. The Guardian noted a very common trap investors will buy a global equity tracker fund, thinking they are safely diversified across the whole planet.
But they don't look at the prospectus.
Exactly. The U.S. stock market makes up 72% of the global MSCI index.
So if the American tech sector wobbles and falls over, your supposedly safe global fund plunges right along with it. You aren't actually diversified. You just bought the S&P 500 with a tiny sprinkle of Europe on top.
Exactly. To truly diversify and protect yourself from a U.S.-centric tech bubble popping, you need to actively look outside that concentration. The sources suggest exploring specific global equity trackers that explicitly exclude the United States. In the financial world, these are often labeled as ex-USA funds or emerging market funds. This strategy intentionally exposes your portfolio to international companies and economies that might be trading at much more reasonable historical valuations rather than the extreme speculative peaks of American tech.
Okay, that covers diversifying within stocks.
Yeah.
But what about defensive assets outside of equities entirely? If the stock market as a whole drops 50%, where does the smart institutional money go to hide?
The Morgan Stanley analysis provides a very clear tactical playbook for this environment. They recommend shifting a portion of your portfolio toward real assets. This is a broad category that essentially means things you can touch or things that possess intrinsic physical value.
Like gold.
Historically, this includes gold. Gold tends to hold its value or even spike during financial panics and inflationary periods because it is a tangible asset, it cannot be printed by a central bank, and it isn't a paper promise from a bankrupt corporation.
What about real estate?
Yes, they highly recommend REITs, real estate investment trusts. These are companies that own and manage income-producing real estate, like apartment buildings, data centers, or medical facilities. They also highlight energy infrastructure, pipelines, utilities. These are real, physical assets tied to essential, non-negotiable human services. Even in a depression, people need electricity, heat, and a place to live.
They also mentioned a specific type of bond. Intermediate duration investment grade bonds. That's a mouthful. Let's translate that.
Let's break it down mechanically. A bond is essentially a loan. You are lending your money to a corporation or to the government for a set period of time, and in return, they pay you a fixed interest rate. Investment grade simply means the borrower has a stellar credit rating. It is highly, highly likely they will pay you back in full. You aren't lending to a risky startup.
And why are these good during a stock market crash?
Because of how central banks react to crashes. If the stock market crashes and a recession hits, the Federal Reserve will almost certainly panic and cut interest rates to stimulate the economy. There is an absolute mathematical rule in bond investing: when interest rates fall, the value of existing bonds goes up.
I see. If I hold a bond paying 5% interest, and the Fed drops rates so new bonds only pay 2%, my 5% bond suddenly becomes incredibly valuable. People will pay a premium to buy it from me.
Exactly. So while your stock portfolio is dropping, your bond portfolio is rising in value, acting as a crucial counterweight and cushioning your overall net worth.
And what if I want to stay invested in the stock market, but I want to be safer? Are there safe havens within the equity market itself?
Yes. Morgan Stanley points toward shifting your stock allocation into less glamorous dividend-paying sectors. You move away from the high-flying tech stocks that promise massive future growth, and you move toward boring companies that generate massive cash flow today. Think utilities, massive insurance conglomerates, and consumer staples.
Back to the toilet paper and toothpaste company.
Precisely. People might cancel their Netflix subscription or refuse to buy $200 Nike sneakers during a recession, but they will absolutely not stop paying their electric bill, they won't stop buying basic groceries, and they won't cancel their home insurance.
Hey.
These defensive companies have incredibly predictable, recession-resistant cash flows. Furthermore, they pay regular dividends. They literally distribute a portion of their profits in cash to shareholders every quarter. This provides you with a steady, reliable return, even if the actual stock price is fluctuating wildly.
It's a complete mindset shift. It's about moving from offense to defense. In a bubble, everyone is trying to capture 50% gains in a month by gambling on meme stocks. But survival is about building a financial fortress that won't collapse by 50% when the music stops.
Exactly. You want to engineer a portfolio that can weather multiple drastically different economic climates, inflation, deflation, high rates, low rates, not just a portfolio that only works in a zero interest rate bull market.
We have covered an incredible amount of ground today. We started by looking at the bizarre, almost parallel universe disconnect between Wall Street and Main Street. We explored how the S&P 500 soars while the GDP plods along, driven by the structural divergence of goods versus services, international currency manipulation, and the brutal conflict between corporate profits and everyday wages.
We examined the deep, persistent illusion of market efficiency. We explored how human cognitive biases like loss aversion, the psychological games of the Keynesian beauty contest, and the blind algorithmic fire hose of passive index investing have combined to inflate a multi-headed bubble that is dangerously concentrated in a handful of tech giants.
We looked at the imminent, flashing danger signs of the real economy, consumer discretionary stocks plunging into a bear market under the crushing weight of tariffs and exhausted savings. We unpack the terrifying compounding math of cyclically excessive deficits threatening to destabilize the currency and trigger 1970s-style inflation.
Yeah, that's a big one.
And we face the sobering, mathematically proven reality that a 60% market correction wouldn't even be a historic anomaly. It would simply be a painful return to normal valuations. But importantly, we didn't just panic. We laid out the blueprint for survival, master your emotions, build a cash shock absorber, and radically diversify into global ex-US markets and tangible defensive assets.
It is a massive amount of data to process. But understanding these hidden mechanics, seeing the gears turning beneath the surface, is the difference between being a helpless victim of the market's whims and being an informed, resilient participant who can protect their family's wealth.
Before we sign off, I want to leave you with a final, provocative thought to mull over. We've spent this entire hour analyzing how the stock market has violently decoupled from the real economy. But throughout this conversation, we've implicitly treated this disconnect like a temporary glitch. We've treated it like a cyclical extreme that will eventually correct itself and return to the good old days where the stock market reflected the health of the American worker.
But what if it isn't a glitch? What if this is the new, permanent architecture of the global economy? What if, in an era of hyper-advanced artificial intelligence, algorithmic high-frequency trading, and total hyper-financialization, the stock market is simply no longer a tool for raising capital to build companies that employ everyday people? What if it has evolved beyond us? What if the market has become a fully closed loop, an autonomous machine designed purely to measure how successfully massive corporations can generate and extract profits without relying on human labor at all?
It's a chilling, dystopian thought. If the economic X-ray machine seems broken, maybe it's not because the machine is malfunctioning. Maybe it's because we're trying to use it to diagnose an entirely new alien species of capitalism that we don't fully understand yet.
Thank you so much for joining us on this deep dive. Keep questioning the headlines, keep looking beneath the surface of your portfolios, and we'll see you next time.